Hello, welcome back. My name is Darson Grantham, and this is Jared. And on this episode or on this podcast, we kind of talk about the real estate market in general. We're both based out of Des Moines, and I'll let Jared kind of talk about what his business is. But I work with buyers and sellers in the more investment community in the central part of Iowa.
Mm-hmm. Yeah, Jared Huseman here, president of the Catalyst team, part of KB Commercial Realty here in Des Moines. Our team specializes in investment property, primarily eightplexes and apartments greater than 8 units across the state right now. So that's kind of our focus. Again, we're based out of Des Moines, but we have properties we're listing and marketing all across the state. Yep.
I mean, we put this content together because there is a lack of education for the Des Moines market, central Iowa market, in our opinions, for the general public to view, right? And so we work with buyers, sellers of all kinds, all across the country, probably across the world, and I know for sure across the world actually. And like Des Moines is just, as every market is, a little different. Every market I would say has a local spin. Yeah, you have the national sentiment, but you know each market has its own numbers, so that's what we're here to share.
Yeah, and then just tie up that we also do this to kind of shed some transparency on the market. We both felt in our opinions that there are not as many qualified investor agents in our market that do a good job, both from residential and commercial standpoints as well. And then in commercial standpoints, I was discussing with the seller just the other day and a buyer as well. At least for a commercial standpoint, there are many agents who will sell you as much as you want to be sold. And they will tell you all of the bells and whistles of a property with none of the downside. So one thing that our team specializes in as well is just telling you the truth. Just say, how's the deal going to go, what we feel the value is, and how we feel you can create more money as well. And I think that's not the reason we do this. It's just to create more transparency,
truth,
and openness in the market of what we're seeing from not only agent standpoint, but an ownership standpoint. As we always state, we're both owners in the market. So we're hitting this from every angle possible to share more with you guys.
Yep, and willing to be wrong. Like, we give our opinions, and quite frankly, you probably could have commercial agents and other real estate agents come on here and say, Darson and Jared, you got this completely wrong. You know, look what you said a year ago. We're like, yeah, I mean, it's possible. The market is a moving scale, and good example, and we'll kind of just get into this, is the pulse of the market is our next kind of segment. And I literally just walked out of a conversation with another agent. He gave me his duplex and said, hey, I've got this off-market duplex. Can you sell it? And I told him a number, and he goes, okay, the guy won't take that amount if agent commissions are in there. And I said, okay, I don't have a buyer for it. He lists it, gets $25,000 more than what I thought it was worth. I was completely wrong. The market has shifted in that aspect, and like that's it's not closed yet. But hey, I was completely wrong, right? So I led him astray. He ended up, the market told him what it was worth, and it's the truth.
At the end of the day, though, I think that's the important part, is that if you do disagree with us or you have different feedback, like, let us know. Like, comment on this video, share it, like whatever you want to do. Like, welcome the conversation. We're all about openness in the conversation. We're not going to cancel you because you disagree with us, any kind of our nature. So that's one thing. But it's funny you said that, actually, because just for this, I walked into this as well. I had a very similar conversation. I had a conversation with an owner, and I shared an example. There was an owner I knew a couple years ago now who got an offer on a property, was going to net $1 million on this apartment complex in 2 years of ownership. And I highly suggested...
Time out. That's $500,000 a year profit, right? Like that's
yes.
pretty good.
This was after taxes, after commissions, everything, $1 million profit. This was a couple years ago now. And I advised him to take that offer. I said, this is a great offer. I think you should take it. And he rejected it. He said, no, I think I can make a little more. And subsequently, he did sell it a couple of years later. This has been about 2 years ago he sold the property. And he made $1.5 million on it. He disregarded my advice, my opinion, and he made more money on it. So, at the end of the day, we just share what we think of the market and our opinions. And we try to be more right than we're wrong.
Yep. He is an intense data analyst studier, so like he's very good at it. I look at high level, I study it, but to say the exact numbers of things, like I'm more of a rounder. He's exact, but like our opinions are based on data that we see, we intake from other people, or we create ourselves. And then also our opinions from our clients, right? So what people have anecdotally.
Well, this goes back to the reason why, it goes to our next segment here, the pulse of the market. So the reason I think us as agents, one reason I love being an agent, is we do get the pulse of the market because I'm talking to any given day 5 to 10 buyers or sellers. So any given day, I'm talking to buyers or sellers who are saying, I'm seeing X or I'm seeing Y in the market, whatever it may be. So this is the pulse of the market. Let's dive into it here. Just before this call as well, I was talking to a seller. He has a small property, small apartment complex in a suburb, and he has stated he wants a high price for it. And I ran it past a couple of buyers. It needs quite a bit of capital improvements. And my buyers are coming back much lower than what the seller wants. And I said to the buyers, I said, I understand that how you feel this property is worth, but with the way the market is right now, there are enough buyers who are going to do their work themselves. They're going to come in there, they're not going to hire third-party contractors, they're going to come in here, do the work themselves, and they're going to make a healthy return for themselves as individual investors. So that's another way of looking at a property right now, and that's how sellers are pricing their properties right now. They're pricing it as if someone were to do all the work themselves and not hire it done. And that brings a very interesting concept and conversation into the investment market in terms of management, in terms of repairs and maintenance, capital improvements. Any of those things change drastically when an owner is doing that work themselves.
What it comes down to too is like, how do you calculate those numbers? And this isn't the main topic, and we'll do it on another time because our main topic is something different. But when you get beat out on a property, it's because someone was willing to take an expected lower return than you were. Like that's the plain and simple of it. Whether it's net worth a lower return or if it's actual cash on cash lower return, they could get financing differently, something, right? Like that is the brass tacks of it.
Or they value their time less than you.
Yep.
If you value your time at $100 and I'm going to spend 10 hours a month in this property and someone else values their time at $20 an hour, then they valued their time differently than you.
Yep.
And they were willing, and that's a return. I mean, it's not just a return on investment, it's a return on time.
Yep.
And that's what's happening now is that investors are taking a lower return on their time than what some other investors might want. And that's what's driving some of our pricing.
It's neither right or wrong, just is.
Which ties, I think, this ties into our kind of our subject matter really nicely we want to talk about today, which is the levels of investors, the levels that all investors have. So, for example, I'm going to give some rules of thumbs here. This is not like the science or the Bible by take it, by scripture here. But what we see a lot in multifamily is, generally speaking, if you have about 24 units, you can pretty much self-manage that. If you have 3 8-plexes, 2 12s, you can pretty much, manage that yourself. You'll be all right.
It's a busy part-time job.
Exactly.
But you can do it.
Exactly. Well said. Well said. And if you get to about 40, 50 units, again, at that point, you're a very busy part-time job. Now you're probably putting in that 20, 30 hours a week of management, especially if you're doing the maintenance work yourself. But you're getting a lot.
And I think I'm going to just chirp in here is because different owners have different mindsets on systems, right? The more systems that you have in place and checklists and processes, the higher number that you can self-manage. But in reality, you're usually just leveraging another body to do the things that you don't have time to do anymore, right? If you're literally doing everything and you're not leveraging anything, that number that you have to get to transfer, to move to that next level is lower. So
that's really well put. And I love what you said, that systems and leverage, because it's so true. If you're using softwares to help you manage your leases, your rental applications, your profit and loss, that's a great way to look at it. Your collection of rents, your ACH payments, whether collecting by hand or even paying your bills, automatic bills, taxes, how things work. But again, general levels and rules of thumb are about 48 units, you're going to need a manager. At about 100 units, you're talking about a full-time job to maintain and manage. A general rule of thumb is for every 100 units, you're going to need 1 full-time manager and 1 full-time maintenance person at about 100 units. That's just a good rule of thumb for investors as they grow. So if you're ever saying, hey, look, I have 24 units now, I'm looking to get to 100, understand that's going to be a different level of complexity.
You're not only finding properties, you're having to manage a team, a significant team.
Exactly, and that's something that I think most investors get, and where a lot of investors get, from my experience, and I've personally been here, is you can get stuck. If you only have, the worst place to be is between 50 and 100 units. That is absolutely the worst place to be. Because if you're at 24 to 50, it's not enough to make it full-time, but it's not enough to make it part-time either. You're working both.
And you see that percentage that you pay the property manager, or you don't yet, but you would have to, and you're like, well, shoot, I can pay someone to just do that. And then you're like, then you go into leadership, hiring, and you have to hire someone. Do you want to do that?
100%, exactly. And again, the worst place to be is that 50 to 100 units, because then you really need to be doing this full time, but you really can't afford to hire anyone yet because it's just not quite there yet. So it's kind of weird, but in that 24 to less, it's actually easier. It's easy to be small, and it's kind of a part-time thing. It's just, that's what I would call a long-term investor who's just kind of 401k. You're just investing in it.
That's a really good analogy.
Yeah, less than 24 units. This is apartments. Houses are totally different. Darson tackled that, but less than 24 units. that property is essentially a 401k for you. You're just trying to pay it off long term, get your equity, cash flow in the day. It's paid off. It's long term. You get more than 24, you're starting to create somewhat of a business around this.
Yep.
If you're above 50, you're starting to get into a serious level of business, and above 100, you're absolutely in this full time as an investor.
Yeah. I'd say houses, it's not that far off on houses because, yeah, I would say it's not that far off.
I think the
Maybe
difference,
a little lower.
I think the difference for houses to apartments comes back to geographic location.
Yeah.
So for apartments, you can have 24 units in one or even a couple of spots. You get 3 eightplexes, and you can still manage them pretty efficiently. If you have 24 houses and they're spread out over a large geographic region, that gets very different.
And I would even argue a little bit just on Des Moines, like the most rentals in Des Moines are typically in the center part of Des Moines, right? And so Des Moines is small enough, you can get anywhere in 20 minutes. From one burb to another burb, 20, 25 minutes. In the Des Moines proper, the center core of Des Moines, it's even smaller than that. It's 10 to 15 minutes. So if you're just buying rentals for cash flow, you're probably in the central part of Des Moines. And so having 30 single families in central part of Des Moines wouldn't be that different than just one 30-plex in a suburb or in the heart of Des Moines. So like, I just don't think that the numbers are that far off.
The thing about that I would say I agree with you.
You can argue.
I also disagree as well. It's just, if you just look at your portfolio, all I'm going to say is look at your portfolio. If you sit down, let's say you own 5 houses, 10, 20, 30, I really don't care what it is. Sometime pull up Google Maps and drop a pin on everything and see if they all fall within a certain radius, a certain circumference. Because I'm going to bet if you have 1 or 2 properties that are outliers of that property, those are probably the ones that are causing you the most headaches.
That's fair. If he's right or wrong, I would recommend doing it just to see how it feels.
Yeah, and again, draw that radius up, and the more, this sounds weird to say this way, but the tighter that circle is going to be of whatever properties you own, the more likely you're going to make money, actually. It's same as Monopoly. Like Monopoly, you want to own on the same street, and that's how you make money. If you own 25 properties and your geographical radius is, to your point, North Des Moines to South Des Moines to East Des Moines to West Des Moines, that's still a pretty big circumference there, and it can be hard to make money. Now, if you own those same 20 houses and it's all confined to the Drake neighborhood, it's a big difference.
Yeah. Well, you don't have to know, even though Des Moines is small, each of those markets that he said are different, right? You're not, for example, if you have a 24-plex or 20 units in one part of the city and you get 30 rental applications, you can tell the other people, hey, we don't have, like this one's no longer available, you didn't win this one, but this next one is coming open. Usually, if that's North Des Moines, they're not gonna also be open to your South Des Moines apartment or house, right? So that does make sense, and it builds efficiencies.
Yeah, and it gives you a better grasp of the market. At the end of the day, it's what it is. I mean, the more coast-centric and the more specified you are, if you own every house on University Avenue in a 10-block radius, I mean, you're going to know the market. You're going to control it here. So this also ties back into and the whole subject is as you have efficiencies, you grow as well. So it's easier to manage if you do have 50 houses or 50 apartment units, and they're all within a few blocks of each other, you might still be able to manage that very effectively because you have efficiencies. You actually are creating leverage, whether you know it or not, you're creating leverage from your shared location of the property.
Yeah. So another kind of on the same topic is, how do I know if I should trade in my 10 single families and buy a 10-plex? Or like, what is that thought process, right? Because you can sell a portfolio of 10 properties and then 1031 exchange that into a bigger property. Would you consider that a different type of investor, or just someone that is continually trading up, trying to effectively use their equity?
Sure.
Is that even a question? I don't know if I asked the question.
Yeah, so that's actually the first question I would ask, is that I would really look at that on an equity standpoint, be evaluating on your return on your equity, which most investors are not talking about enough. Everybody loves talking about your cash on cash, your ROI, but very few investors talk about your return on your equity enough. And especially when you're seeing a rising market like we've seen in the last couple of years for apartments and houses, you might have bought that apartment complex or house for pennies on a dollar that now it's worth substantial dollars, and your cash flow might be great on what you initially bought it for, but your equity is low. I think tying this back into the question of what investors should do, for me, I don't know about you, but my advice is always going to come back to what's the end all, what's the goal? What is your goal for this property? Or a goal in general for investing. And if your goal is back to that, let's use the 401k analogy. I just want to have 401k. I want it to be easy. Maybe you stick buying houses because it's easy and you know it. And you have your systems and your leverage around that. I loved your systems and leverage analogy. If your goal is to, I can tell you right now though, if your goal as an investor is to say, I want to own 1,000 units or 2,000 units, there's almost really only one way to do that, and that's go into apartments. And that's just the only way to do it. And if you flat out say, I want to own, let's just hypothetically say, billions of dollars of real estate, it's very hard to do it with houses. You're going to have to go to apartments, probably commercial as well.
Yeah.
So I'm always going to tie it back to when is the right time to move up in your investment career. I think you need to ask yourself that, ask your partner that, or partners.
Or spouse.
Yeah, no, by partners, I
mean?
mean not just spouse as a partner. I mean your actual partners if you have them as well. And by partners, I'm going to actually add another one that's not talked about enough. By partners, ask your staff. If you have managers, maintenance guys, you have HVAC, plumbers, and you say to them, hey, I want to grow from 20 houses to 50 houses or grow from 20 houses to apartments, are they going to grow with you or do they want to do that? Because I can tell you from a repairman standpoint, it's very different working on houses to apartments. So when I say talk to your partners, I mean talk to everybody in your life that has to deal with this.
Bankers probably too.
Bankers as well. It's another great partner. Banks are one of your biggest partners you ever have. 70-80% of it usually is your partner. But talking about that, and I think it's going to come back to, again, I'm always going to advise what's your end-all goal and where's that goal at for, I'm going to go 30 years, 20 years, 15, 10, 5, and are we on path for that?
I agree.
What do you say?
This is very overwhelming for when I decide things because I'm like, I don't know what's going to happen next year. You know what? I'm going to work my ass off and I'm going to see what happens and then I'm going to readjust. And I'm going to do that every single year. So my goal in 5 years, like, it's likely going to be too small if I make it now, right? In reality, because you always, what is it, the saying? Like, you underestimate what you can do in 5 years and overestimate what you can do in 1 year.
I'll say you overestimate you in 1 year, underestimate you in 10 years. Yeah, Bill Gates said it.
Yeah, like, it's just, so, yes, you should have a general idea, 5, 10, 15, 30 years. But then, like, if I got to 100 units, like, that's a damn good baseline to just say, you know, I can feed my family, I can do anything I freaking want. Do I want to grow? I'm
going to answer, so here's how I'm going to answer a book, actually. We both read it, I know we have. It's called The Psychology of Money. If you have not read it, go on Amazon now, order it. It's a phenomenal book. And The Psychology of Money talks all about this same question of how do I want to run my money? Because there are people that are billionaires who are still broke because they spent all their money. Yeah, there are people I know that own 5 houses free and clear, and they are very, very happy because they don't need much more than that. So again, it comes back to the goal you want. So the answer I have to you, or anybody watching if you're looking to grow, is that property causing you a headache, and why do you think something is going to solve the issue?
The grass is always greener.
But
it's not.
It's not, but that's the point, though, is that if you're having headaches around your own properties, then maybe it's time to shift. That's what I can say. If you're having headaches, or if you're having doubts, concerns, anxiety, hard sleep at night, whatever it is, problems, then maybe it's time to consider transitioning to something else.
That's true.
But at some point, if you're just like, hey, I want to try this out because it sounds like it'd be fun, maybe it's best time, maybe it isn't. I don't know. It depends on your goals. But that's going to come back in the psychology of money is what do you feel most comfortable with? Because again, I got some clients, I can think of 2 or 3 right now, who actually don't even play in apartments, they own houses. And they own multiple houses, free and clear, and they always say, I could grow, but why? I mean, I have plenty of cash flow, I've got plenty of equity, my family's taken care of, I work 10 hours a week, I have no anxiety, no stress, I have a great life. And I say, you're absolutely right.
Sounds boring as hell.
Yeah. Sounds boring to us who have bigger goals, maybe ambitions.
But it's true, I agree.
But that person's going to be. So the answer to that is, I mean, again, always come back to what are your goals for where you want to go, I think, is my answer.
Yeah, it is. It's true.
And it's this, and to me, the biggest thing I can say is this. If that property is all giving you, this is my personal opinion, let's take it for that. If that property or your portfolio is giving you any kind of stress, anxiety, whether it be in management and the debt you have, whatever it may be, it's time for a change. Because at the end of the day, your investments, I don't care whether it's stocks, crypto, NFTs, or real estate, should never give you anxiety or stress levels. They're meant to enhance your life. And if they're ever giving you any kind of levels of anxiety or stress, it's probably time to either pull back or look to do something different. That's just my personal thoughts. That should be fun.
The real estate agent therapist.
Right. So we are.
No, I agree. We talk about this stuff all the time. I get it.
But
Makes sense.
I mean, that's what I can say. I mean, at the end of the day, it's what it is. If it's giving you any kind of that, investment's supposed to be fun. Like, I love my investments.
Doesn't this come down to, like, I'm just going to go on a tangent, life in general, right? What in your life causes you stress?
Right.
Get rid of it. If it's a spouse, That's another issue. Don't do that. If it's a kid, there's other things. But like, if it causes you stress, find a way not to do that.
I think that actually ties into, okay, let's tie this back into what we're talking about here with growth of investors. Let's tie that too. If you have one of your partners giving you stress, not your spouse or partner.
Business partner.
Business partner. If you have a manager, if you've got a banker, if you've got someone who's causing you stress levels and they're not helping you get to where you want to get to, whether that's stay small or that's get bigger, then get rid of them. There are plenty of people who want to partner with you.
And not get rid of them in a bad way, just amicably, like, hey, we're not agreeing. You go your way, I'll go my way. Give them, here's a trick to this. Give them more than they probably expected when you do split. And like it'll feel good for you, and they'll feel like they always owe you.
And this actually ties in really well too about the growth of an investor as well. Understand this. We discussed this actually, I think it was last week, a couple weeks ago. Partnerships can be great things. They can help you grow to levels you've never seen.
It was our very first one, the syndications.
Yeah, syndication. So partnerships can be great. They can help you grow to levels you have not seen. And understand that too is that's another level. If you own 24 units by yourself and you want to go out and buy a 100-unit complex, but you can't financially afford it yet, it's going to require partners.
Yep.
So understand that that's a growth level that you need to have a conversation about with your partners, and are all you guys on the same alignment for how you want to grow as partners, as individuals. So have those conversations too. And again, if your partners are not feeding into your life, or you choose, if you get four gentlemen, 4 guys, I'm saying guys, loose term, it could be 4 women.
Easy now.
No, it could be 4 women, whatever. It's just typically we're a male-dominated industry. And if you have 4 gentlemen and one's goal is to own 100 units and one's goal is to own 1,000 units, that's going to change how long that partnership stays around and the growth trajectory of that partnership.
Yes.
And maybe you do buy 100 units and that's it. And then that other person who wants to own 1,000 goes out and finds other partners to own more of them. That is okay.
Yep.
But you need to have those conversations around that. And again, always tie it back into what do you feel most comfortable with, what your partner feel most comfortable with. And again, it ties into your banker as well, manager, everybody involved.
And don't be afraid to change this.
Yeah.
Right? Like I was initially buying strictly for cash flow because I was trying to replace a W-2 job. When I realized how much fun it was to help people buy rental properties and make a commission as a realtor on that, build a business around I don't need to replace that income. Like I don't need to sell very many houses to feed my family. Anything I sell above a certain amount is gravy, and that's where I use to go buy simple properties instead of high cash flowing properties. So anyway, to round out this episode, hopefully we gave you all the answers, yet we didn't give you any of the answers because it's totally up to you.
So to tie up that real quick, I'm going to say is, I think one of our goals of this podcast is not to give you the answers per se, it's just to help you ask better questions. And hopefully that's what we did here, is we helped you ask better questions. Because if we help you ask better questions, you're going to become better investors, whether it's syndication, whether it's growing as an investor, wherever it is, just ask better questions.
And then when you call us, we'll have to go through less of the elementary stuff and have real fun conversations.
Have some topics about how we can actually all make money. But yeah, so again, hopefully we're helping you ask better questions. As Darson mentioned, Jared Huseman, president of the Catalyst team, part of KV Commercial Realty here in Des Moines. You can Google us, catalystteam.com. It's spelled K-A-T-A-L-Y-S-T. Catalyst team, I know it's long, he's going to laugh at me. Otherwise, just Google me, Jared Huseman, Jared Husemann. I pop up all over the place.
And my name is Darson Grantham. I run a different team at Keller Williams here in Des Moines, and I run more on the small multifamily residential side. And you can find me, obviously, on this episode. You can YouTube my name or shoot me an email, dgrantham@kw.com.